Hello and welcome to our online classes. In this video, I want to talk about the difference between primary markets and secondary markets. Okay. Uh, in our first video, we had spoken about what exactly are capital markets, and then we had broadened our discussion and talked about what were financial markets. In this video, I would like to talk about a very important difference or a classification in the capital markets, namely the primary market and the secondary market. And then in this video, I want to talk about the topics that we are going to cover extensively in the future videos in this series of lectures. Okay? Now, primary markets. Well, as we had spoken about in our first video, capital markets is a way for institutions or companies to raise capital, right? So a company will issue securities and investors will buy those securities and will provide capital, okay? So that's what a capital market was mostly for. Now, a primary market is a market where the company is directly participating in the market and is issuing new securities to investors, and investors are buying those securities. Now, these securities could be debt or equity. We will cover these terms in later videos, definitely. So, companies could issue new debt or equity or a combination of the both, and investors can buy those financial securities and provide capital to the company. Examples of primary market operations are IPOs, which are initial public offerings, or NCDs, which are non-convertible debentures. Now, IPO is a part of equity. Debt is a type of, NCD is a type of debt financial security. But the common thing about all these is that these are new financial securities that are being launched by the company to raise fresh capital. Okay? Fresh capital. But then what is a secondary market? Well, suppose a company does an IPO and it issues new shares, right? And you as an investor buy those new shares from a company, say XYZ Corporation, okay? You as an investor, you participate in the IPO and you buy the new shares that are offered by XYZ Corporation. Now suppose 1 month or 2 months down the line, you as an investor are in need of cash and you want to sell your financial securities. You want to sell the shares of XYZ Corporation. How can you do that? Well, you can go to the XYZ Corporation company and tell them, look, I'm in need for some cash. I would want you to buy the shares from me. Well, XYZ Corporation could end up telling you, look, we have a project coming up which is capital intensive. We have to invest a lot of money in the new project. Hence, it will not be possible for us to buy those shares from you. As an investor, what would you do then? Well, the only option left for you is that you have to go to somebody else, another investor, who is willing to buy those shares from you, right? But where will you find an investor like this who is willing to buy the shares of XYZ Corporation from you and provide you with cash? Well, that's where the secondary market comes into the picture. The stock market, which is a prime example of the secondary market, is a market where two different investors participate to buy and sell financial securities. Please note that the company whose shares are being traded in the secondary market need not be a participant in the market. So the investor A, as we can call him here, and investor B, as we can call him here, may not be related to the company. They might be two different investors, two independent investors who have a view on the company and want to either take up ownership or relinquish ownership of XYZ Corporation. Well, why the term secondary market? Well, because the shares which are being traded in the secondary market are sort of second hand, aren't they? Because you who had participated in the IPO of XYZ Corporation, when you sell the shares to another investor, say investor B, you are in a way selling second hand, right? Well, that whether it's first hand or whether it's second hand has absolutely no impact in the market for financial securities, but that's where the term is actually coming from. Okay. So one important thing to note is that most people who are new to stock markets don't actually realize that the money that they are putting in to buy shares in a stock market is not directly going to the company. It does not reach the company, right? It is actually going to the investor who is willing to sell the shares, or the investor who is willing to sell the shares. It is he who gets the money. So when you participate in a stock market, you are not sending money directly to the company. The company has already raised its capital via the IPO or whatever new financial security they had issued in the primary market. Okay, so this is a key difference or a key classification of the capital markets, namely the primary market and the secondary market. Okay. Now, I also want to talk about what we are exactly going to cover in the capital markets in the future videos under this topic. Okay. The first thing that we are going to talk about in future videos is going to be initial public offering, or IPOs. Okay. Now, IPOs is a primary market operation. It's primary market where a company issues new shares to investors, okay, and investors buy those shares and provide the company with capital. Okay. Now we are going to look into some important issues or questions while we cover this topic of IPO. We're going to look into the reason why companies do IPOs, because if a company needs capital, it can always go to the bank and ask for a loan, right? Why does it need to go directly to investors to raise capital? Well, there are some advantages of doing that, and that is what we are going to cover in the future videos. Then we are going to talk about some disadvantages of doing an IPO. Of course, there are some disadvantages of doing IPOs, and we would like to point out what they are. Then we're going to talk about the process of an IPO in India. What does a company need to do to raise capital via an IPO, via an initial public offering? Then finally, we're going to look into some important terms or jargon in the IPO. And then we're going to ask the question, what you as an investor should be looking into before you decide to invest in an IPO. Okay? And the next thing that we're going to talk about in this series of videos is stock markets. Well, of course, that's what this course is about. It's about stock markets, and we're going to explain what exactly is a stock market. We will cover a few concepts in those videos. We're going to answer the question, what is the Nifty and the Sensex? Okay, not many people who are new to the world of stock markets don't exactly understand what is exactly the Nifty and the Sensex and how it is calculated. Okay, so we are going to answer that question in details. We're also going to look at the various types of the different stock markets in India. Well, there are many stock markets in India. The most two popular ones are NSE, the National Stock Exchange, and BSE, the Bombay Stock Exchange. Well, there are other stock exchanges as well, like the Calcutta Stock Exchange or the Multi-Commodity Exchange Stock Exchange, the MCXSX. So we're going to talk about the different stock markets in India and what are the pros and cons of various stock markets. Okay. Finally, we're going to look into some rules within the stock markets in India called circuit breakers. Now, circuit breakers are a set of rules that are applied to stock markets in India. And we are going to cover that because you, as an investor or a trader in stock market, need to be aware of what and how the circuit breakers work. Okay. So these are the things that we're going to cover in the future videos in this topic. Till then, goodbye and good luck.